new post-crisis regulations for the banking industry be disastrous for the economy, as JP Morgan Chase CEO Jamie Dimon said last week? Well, one key ingredient in those regulations are stricter capital rules, and an exclusive Bloomberg analysis suggests the future may not be so dim after all. For more, the man behind this report, Bloomberg Government economist Christopher Payne. Chris is with us this morning by phone from Philadelphia. Chris, great to have you back on the show. Walk us through your analysis here. What exactly did you find about banks such as Bank of America, Citigroup, and JP Morgan, which I just mentioned?
Well, what we found was that if you looked at the end of last year, the top 10 bank holding companies in the U.S. reported a Tier 1 capital ratio, so that's the sort of core capital ratio of 12.7%. And with our analysis, we worked out that if you had applied Basel III at the end of last year, and that's what the regulations are called, they're called Basel III, then these banks would have reported 6.3% common equity Tier 1 capital. That's the new core capital ratio. So almost halving the ratio that they showed at the end of last year. Now, obviously, that's a huge amount. And essentially, one of the things we realized was that if Basel III had been in operation, say between 2001 and 2007, some of the largest banks, the really systemically important banks, could have held up to 7%, could have been required to hold up to 7% more equity going through leading up to the crisis. And obviously, this is very important because a lot of the banks had to absorb losses, both because of the housing market or on some of the positions they were in. And they might have been able to absorb those losses without going to the government. So these regulations are all about trying to make sure that in a future crisis and a future economic downturn, the government isn't forced to step in and bail out these big banks.
Okay, so your analysis did two things, if I understand it correctly, Chris. You looked backward and you looked forward. Let's stick for the moment with the backward and the current situation. Leading up into the crisis, and as of right now, despite what the banks report, according to the new regulations, they would be undercapitalized. Is that correct?
That is absolutely correct. Again, there's some uncertainty about what Basel III will finally look like. Everyone knows that the big banks will be required to have this 7% ratio. And actually, at the moment, or at the end of 2010, we calculated that they were at 6.32% on average, these top 10 banks.
And if I'm not mistaken, three, right, that actually exceeded that 7% threshold: Goldman Sachs, Bank of New York Mellon, and PNC Financial. Everybody else was underneath it.
Everyone else was underneath it. But of course, they've actually got up to 2019 to get ahead and get into these regulations and get into the right shape. Now, for these biggest banks, there's a lot of uncertainty about what they're going to have to target because basically the regulators around the world are saying, well, these systemically important financial institutions, these SIFIs, will actually have to have up to 10%.
So let's assume for a moment, Chris, if I may interrupt you, that it is 10%.
Yeah.
And that most banks have to have 7%. The big banks like Goldman Sachs and JP Morgan have to have 10%. Yeah. Will they be able to make it between here and 2010 without having to do things like sell assets, for example, or issue additional equity?
Well, in our calculations, we think that all the banks will be able to get there to the new target by 2019 without having to raise additional equity capital, so without having to dilute existing shareholders. However, they will have to reorganize, in some cases, their business and refocus it on less risky ventures, if you like, and some of them will have to make sales in non-consolidated subsidiaries. Citibank just announced one, I think, yesterday, of an Indian bank. To some extent, most of the banks should be fine, but banks like Citibank and Bank of America will probably have to do a little more with their balance sheet in order to make that target. The key thing, though, I should add, is that they will have to lower their dividend, keep a low dividend payout ratio until they hit the targets. To put that in context very quickly, before the crisis, banks were paying out roughly 40 to 50% of their earnings. Since, in the last 2 years, on average, these same banks have only paid out 8% of their earnings, and Citibank hasn't actually paid a dividend for 2 years.
Chris,
so they'll have to continue to do that until they hit these targets.
Chris, I'm going to have to jump in. Chris Payne of Bloomberg Government joining us with his analysis. The bottom line, banks undercapitalized today, but his analysis suggests that in the future they will be able to meet the new Basel III standard without drastic action.